Welcome to Unlocking the Decentralized podcast. In this episode, cryptocurrency expert Abhi Soomaney explores Web3, blockchain, cryptocurrency tax and investment while engaging with industry pioneers, technologists, and investors. Here is your host, Abhi Soomaney.
Welcome to the sixth episode of Unlocking the Decentralized. Today I'm going to talk about using cryptocurrencies for illicit activities including tax fraud, theft, and wallet hacks. So let's start with what is a blockchain. Now, in simple terms, blockchain refers to a massive database of transactions and information related to each transaction you make on that blockchain. Now, there's two types of blockchains. One is the private blockchain, second is the public blockchain. Private blockchains are basically created by companies for internal purposes. For example, if a certain company wants to store, client data, so they will store it on their private blockchain and only team members will have access to that information. On the other hand, there's a public blockchain where we make transactions. So for example, if I'm making transactions using Bitcoin or Ethereum, I'm using the public domain or the public blockchain where all the database is stored together, which is more like an open database. So it's not that only a certain number of people or certain people can access this information, but it's more like everyone has access and equal view to this information. A cool feature about the blockchain space or the blockchain in general is that no transactions can be deleted or altered in here. So it's a good tool that can be used by especially accountants or even in the healthcare industry for just storing database. But when it comes to just storing information or even making transactions, there's going to be no name as such to each transaction. So for example, when you make a transaction on the blockchain, it's going to have information about the sender, receiver, timestamp, quantity of coins, and what coin was sent from one place to the other. So for example, if I send certain number of tokens to another wallet address, so my name is not going to be mentioned on the blockchain database, but my wallet address will be mentioned. Now, that being said, it might seem that anyone can make an illicit transaction using the blockchain or just, cryptocurrencies in general. Now, it's a yes and no. I'll explain that in further detail. But first, let's start with how each transaction, is entered on the blockchain and what is the entire process of this. So as you make a transaction in Bitcoin, you're essentially using the Bitcoin blockchain. Now, all your information about the transaction, including, as I mentioned before, the sender's address, receiver's address, transaction amount, quantity, timestamp, and all the related data will be, sent to the database. And then there's a unique transaction hash that is generated each time the transaction enters a block. Now, once that information is gathered and it enters the block, that particular block essentially joins another block that was pre-existing on the blockchain. So for example, it is basically like one following the other. So the transaction hash that was generated by the block, is generated based on the preceding transaction hash that was already created for the previous block, which is why, it gets its name with the blockchain, because it's a chain of blocks that are interlinked with one another. Now, smart contracts are a very useful part of the blockchain. They're basically agreements that have to be executed once both parties have basically fulfilled their requirements without wasting time, with cross-checking and stuff like that. So, either it's done rightly or it's not done at all. Now, this can be used in many industries. Like, think about it, legal purposes, real estate, healthcare, and any other field that requires an agreement in place, which is basically any business that works. If all transactions now that get stored on the blockchain, and it's basically an open database that everyone can have access to. So how is it possible that anyone can make an illegal transaction on the blockchain and basically get away with it? Now, I have assisted a few clients, in cryptocurrency fraud accounting cases, that's forensic accounting cases, where we have tried to track down a few wallet transfers and just try to track, where the coins are going. So what I personally experienced is that when you're sending coins from one wallet to the other, it can be tracked to a certain extent. For example, if I'm sending it from one wallet to the other and then from there to somewhere else, you can do a transfer analysis basically to see how far or where the tokens are currently located. But the minute these coins go to an on-chain exchange like Coinbase or Binance, even if you look up the transaction hash on something like a Etherscan or the Bitcoin blockchain, it's going to say that these coins were sent to Binance. Now, it is very important that on-chain exchanges like Binance and Coinbase, help clients to solve the case in a way, or just help them with data when such situations take place, when you really want to track down where the coins have gone after getting stolen from your wallet, or else it's pretty much not possible to track it. Because think about it in this way: when you deposit coins in a wallet that is associated with an on-chain exchange like Binance, it has a massive pool of transactions where one of your wallet transfers get into. Now, to track that, where the coins went from Binance, you need to summon Binance and basically just audit their procedures that which can help you locate those transfers. Another way that I've seen, illicit activities occur on the blockchain include transaction splits. So, for example, if, you send coins from one wallet to the other, now the receiver tends to split those transactions into multiple wallets, because it doesn't cost anything to create a wallet, so you can make how many wallets you want. And there's no threshold, like, you can split that one Ethereum into 1,000 different denominations. So once you do that, it is very difficult and time consuming and costly to basically just track those coins as to where each quantity has been sent. So let's talk about what exactly does anonymous mean. Now, everyone is talking about how crypto is anonymous and all transactions are anonymous. Crypto wallet addresses are basically anonymous because they do not include the person's name. Now, this includes the sender and receiver. The only information you are going to receive on the blockchain is basically the sender's address and the receiver's address. So there's no name and identity that's disclosed over there. Typically, when you wish to trade on an on-chain exchange like a Binance or Coinbase, you need to go through the basic KYC, which gathers all your information, state ID, which basically prove your country of residence and existence overall. So anyone can basically go on the blockchain and find certain wallet addresses that are currently holding billions of dollars in worth of Bitcoin and Ethereum, but you won't really know who the person is. On the other hand, if you open a bank account and store millions of dollars in there, the banks know who that is and how much wealth is held by each individual. So that database is essentially transferred or provided to the government, and now the government knows how much cash you have. But when it comes to the blockchain, all you know is that okay, this X address has this much of Bitcoin stored that's worth billions of dollars, but you'll never know who that person is. I have a few examples to share about real life, cryptocurrency thefts that I have heard of or having my clients experience in the past. Now, the first one and the most interesting one is phone hacks. So what happened here is that, one of the client that I was assisting, his phone got hacked by the hacker, and the hacker had access now to the client's phone. So essentially the mobile service provider was hacked, and the hacker was able to access all exchanges and wallets that the client owned and transferred out coins to his own wallet. There's a lot of online wallets available today, like MetaMask and Trust Wallet, that are essentially third-party companies that are allowing investors to open up their wallets. These are very easily hackable because firstly, it's online. So, there is a system that hackers have or they have come up with that can actually help them hack into your wallet once they have that address with them. Yes, the chances of this happening are lesser, but then there is a slight possibility. So, for example, if you're holding coins over even $100,000, then why would you want to risk that money with a third-party platform when blockchain is all about, getting rid of third-party integrations and reliability overall? Another interesting fraud case that I came across was one of our client was asked, to send certain Bitcoin and Ethereum to a third-party company that's located overseas. Now, what that company essentially promised is that they will use these coins to trade on behalf of the client. There was a fancy portal that the client had access to, and he could see that, yes, the money is going up in value, and now that $5,000 investment is $160,000. So there came a point where my client, told that company or the assistant who he was working with that, okay, now he wants to cash out everything. So that person said, okay, you can cash out, but then you have to send us about 10% of the total value of how much ever you're cashing out as a fee. So what the client did is the client transferred over $16,000 to that company in the form of Bitcoin again. Once these coins were transferred, that company again told the client, okay, now we've got the 10%, now we need another 10% just as insurance because we will be transferring a big amount. That's when things started to get a little skeptical, but this client wanted the 160K because now he had already sent 16,000 in addition to that 5,000 investment. So okay, another 16,000 goes as insurance fee. So now the client is in around 32,000 plus 5,000, $37,000. And then the company started to ghost him. There was no response, and when the client then started to investigate and find out about the company, there was no such law that could actually support this client and help him get the money back. Moral of the story is cryptocurrency is all about, self sustainability. There are thumb drives or offline ledger wallets where you can store your own tokens. Anytime you need money, you can transfer it from there to an online exchange, a secured platform like something, a Coinbase, and then just sell how much you want or trade with how much you want, and yeah, use it in your best benefit. But if you rely on any third party platform or anyone who's trying to promise you certain things that, increases your wealth, that's probably going to be a scam. So you should be aware of that. Now, as I already mentioned, such theft, basically you transferring coins from one place to the other, or the hacker transferring coins out of your wallet to some other wallet and then from there to another, so on and so forth. This is not really traceable because, at firstly it happens anonymously, right? There's no name on the blockchain. There's an address, okay, fine, that your coins have gone out from your wallet and sent to this random address, and then from there to 10 different other addresses. So you can literally see that your funds are moving from one place to the other, but there's no way to track any person behind it unless you can actually ethically hack into the wallet where the coins are currently located and get them back for yourself. There can also be situations where clients actually or investors send tokens to the wrong address. So what happens when you mistakenly send tokens to a wrong address by just typing one of the letters wrong? It's gone. There's no way to reverse a transaction on the blockchain, which is the whole purpose of the blockchain, that it happens instantly, and there's no way to alter that information or change something that's done. Now, that's why whenever you send tokens, just be sure that you double check the receiver's address, because it's not like a bank transfer where you send it to the wrong bank account and you can ring up your bank and be like, hey, I sent it to the wrong bank account, so I need you to hold that transfer and reverse it for me. I look at this as a small price that investors need to pay for, enjoying the feature of the blockchain of having instant transfers, and also, not relying on third party institutions like banks. So whenever you're sending coins from one place to the other, just make sure that you double check the address and send it very securely. Now, talking about transfers, we can obviously relate with trade that happens on using cryptocurrencies, especially international trade. Now, first, let's start off with domestic trading. Now, if I am providing a good or service, I can exchange that goods or services against cryptocurrency, which basically helps me receiving payments in cryptocurrencies. So I'm not just, taking money in exchange of services. Now I'm also having that being invested immediately. Another cool feature about, providing goods and services with cryptocurrency is that it increases in value. Now, it depends on the market forces, of course, but, if I'm doing such kind of trades and receiving payments in crypto, even the clients that we assist always say that, taking crypto as payments is a big perk, because on an average, we notice that most of the value in invoices are lower than how much we received in crypto. So it's a benefit for business owners. Yes, the bookkeeping for this is done very differently. Instead of you receiving just cash in the bank, you have to create multiple asset accounts and then run certain journal entries. But then you can hire professionals who can actually assist you with maintaining the books when you're receiving crypto as payments. Now let's move on to international trade. Now, for example, if I'm buying and selling goods or buying goods from an international country like China, if I send any payments from my bank in the US to China, there will be firstly forex fees, currency variance, rates. There's going to be T plus 3 to 4 days, transaction plus 3 to 4 more days for the transaction to actually take place and process. There will be a detailed explanation that I have to submit to my bank. That will also be tracked by the government and might also raise certain red flags and audit my account because I'm transferring a lot of funds to a bank account that's owned internationally. So what happens when I trade with crypto? Now, when I'm making an international trade using cryptocurrencies, that transaction processes within a few minutes at the most. The person who's sending me the goods gets his payment within 2 to 3 minutes tops. And then once the payment is cleared, my goods are shipped and the deal is confirmed. So the only drawback with, making international trades or any sort of trades with cryptocurrency is you cannot reverse that transaction. So for example, if I make a payment to a vendor who I'm not too aware of or who I don't know in an international country, and the payment is made, but the receiver or the person who I'm buying goods from says, hey, I did not receive it, or he just sends me damaged goods or doesn't send any goods at all, there's nowhere that I can go file a complaint or get my money back. Now, even when it comes to making domestic transactions within the same geographic location with clients, I can reach out to the bank and be like, hey, I did not make this purchase, and get my money back as a customer. Or as a business owner, I can be like, yes, this good or service was rendered or provided and the customer did not make any payment, so there has to be an investigation. So there is a third party actually making that dispute for both parties here. But when it comes to crypto, there's no dispute. Once the coins are sent, that's all about it. There's no way to get that money back, irrespective of what happens with you thereafter. This is back in 2017 when I was having a conversation with one of my clients, and I happened to ask him, what's your portfolio value like? Like, what are you going to do with so much cryptocurrency? And just for the record, as of now, his value, just portfolio value in cryptocurrency is like over $600 million. So back in 2017, he told me that, look, I'm going to keep all my money in crypto. That's most of my wealth. And if I feel that this is not the place where I want to be, I don't need to wrap anything up or sell anything. I can just leave myself, and I have a ledger thumb drive that has all my wealth stored in it, that is very secure. If I want cash instantly, I can transfer these from that to an on-chain exchange like Coinbase and use that money for whatever I want. That was a really smart move, and that's when I thought that cryptocurrency has a lot of potential back in 2017. And today we are sitting in 2022, where all the use cases of cryptocurrency has actually evolved, and everything that the client told me back in time is actually working today. Now, people might think that tax fraud is not really illicit, but it is an illegal activity to make in terms of, as an investor's perspective. So if you're making P2P transfers, for example, peer-to-peer, where you don't really need to rely on on-chain exchanges that actually do KYC to track your transaction, then there's no way that anyone can track those transactions as such, because I'm sending tokens from one address to the other. Now, in exchange of that, I could have gotten any good or service. So no one's going to have the record of, that transaction. To make sure that these transfers are actually tracked by the government, at least the US government has set certain guidelines that, for example, if I am making transfers in and out, all combined, within a certain tax year that exceed $10,000, that basically red flags my account, and it gives the government agencies to pretty much audit that account. So that's a good initiative to make, to just track down any sort of tax fraud that can potentially happen. And I recommend this move to all countries. Because think about it in this way: if you buy Ethereum on an exchange like Coinbase, and then you send that Ethereum to a MetaMask wallet or an offline wallet, from there you can do many other things and earn a lot of more money off the chain, which cannot be tracked by anyone. For example, NFTs. You buy an NFT for $500, which is now worth $200,000. Now you get that money back in ETH into your wallet address, which is not sent back to an on-chain exchange. So no one really knows how much ETH do you own right now. But if you send that Ethereum back to your on-chain exchange periodically, no one can even track what was your cost basis for that Ethereum. So that is a big loophole in the system that needs to be tracked, in my opinion, which is why the US government has imposed this threshold of $10,000 more than transfers cumulatively. Same applies with DeFi. Now, if I make transactions using a platform like a Uniswap or a Shiba Swap, it all happens off the chain. So I'm using Ethereum that was sent from an on-chain exchange and then onto my wallet address. I made money on NFT, and then I keep that Ethereum in my off-chain wallet. And then I start doing some DeFi, make more money in farming, staking, liquidity pool contributions, whatever I do. So now that $5,000 initial investment goes up to $800,000, which happens. I have experienced that with clients when I do their calculations. So who is keeping a track of the cost basis for Ethereum when you initially invested in an NFT, moving on to you receiving ETH by selling that NFT, then putting investments in different liquidity pool providers on the DeFi platforms like Uniswap. So the only way I see that this can be tracked is, to make decentralized finance platforms, that's DeFi platforms, into centralized platforms that can be monitored by governments. But then again, that kills the whole purpose of cryptocurrencies in general, which is being anonymous. Two other, mediums where you can actually make money off the chain is nodes. There's a lot of clients that are buying these nodes where you can buy a node, incur certain monthly expenses to maintain that node, and then you get airdrops in terms of rewards where you can get an NFT or you can get certain tokens. And those tokens can be in any form. Like, you never know whether it's going to be in Ethereum or any other altcoin. Same goes with crypto gaming. Like, you can get certain tokens by winning certain games online, or you can also be on an online crypto casino and win, say, 20 bitcoin, and then you receive a deposit of bitcoin in your off-chain wallet, which still no one knows that you have, and then you keep transferring smaller quantities on chain like a Coinbase and then sell it periodically. So this way no one will be able to track how many coins you actually own, what was your cost basis, when did you buy it. I have a few recommendations for investors, to just stay away from all these theft, safeguard your investments from, all these illicit activities, and stay away from doing anything unethical when it comes to cryptocurrencies, because there's a large number of audits that are being done, and audit notices are being sent on a random basis even today. You should hold majority of your investments off the chain. Like, for example, I mentioned a lot of times in this podcast, that's off-chain wallets that include, just thumb drives that have a wallet address to it, but now it's not an online wallet, so it cannot be really hacked. You can store all your coins in multiple addresses. So instead of, saving everything on one platform, you can split that investment, or you can just split your portfolio in 10 different platforms. So in case one platform gets hacked, you still have 9 other platforms to rely on that have the same quantity, each holding respectively. There's two-factor authentication that is most recommended when you use an on-chain platform like Coinbase. And then there's Google Authenticator, which is backed by a Face ID recognition. Now, that's another big feature that can be activated, because even if your phone is hacked, even if your, address is hacked, to access any sort of data, you would have to go through Face ID recognition, which is a great feature that can be used by all investors just to safeguard their investment. I hope you liked today's episode, and in the next episode, I'm going to talk about cryptocurrency banks and how, exchange houses like Coinbase, Crypto.com, Binance are actually acting like banking institutions and providing similar services, and how will this impact traditional banks. Thanks for listening to today's episode, and I hope you stay tuned for the next one.
We hope you've enjoyed this episode of Unlocking the Decentralized. This podcast is sponsored by CryptoTax, your one-stop solution for cryptocurrency taxes. Learn more at cryptotax.co.in.